You take $20,000 out of your 401k, one withdrawal, and when tax season comes, the IRS treats you like you took out $37,000. Where did the extra $17,000 come from? You never touched it, you never spent it, it never landed in your account. But you are paying tax on it anyway. That is not a glitch, my friend. That is a trap built into the rules. And the part almost nobody tells you, it has nearly nothing to do with how much you saved. It comes down to the order you switch your income on. You could have saved for 30 years, paid off the house, done every single thing right, and still walk into it, simply because nobody ever told you the order mattered. If you are close to retirement, you likely have 3 separate paychecks lined up and waiting. Your 401k or traditional IRA, Social Security, and for some of you, a pension. They all feel like the same thing, income. But they do not follow the same rules, not even close. One of them you control completely. One of them you can speed up or slow down, and one of them switches on whether you are ready or not. Turn them on in the wrong order and they start working against each other. Before I show you the right order, one small favor. If you would rather keep what you earned than tip the IRS by accident, tap the like button and subscribe. That is how this reaches the next person who is about to make this exact mistake. All right, quick setup so the traps make sense. Paycheck 1, your 401k or traditional IRA. You never paid tax on that money going in, so every dollar coming out gets taxed like regular income. The upside, once you are past 59.5, you are in full control. You choose when, and you choose how much. Nothing is forced on you until required minimum distributions begin at age 73. Paycheck 2, Social Security. You can start it at 62, but the check gets cut around 30% permanently. Hold off past your full retirement age, and it grows roughly 8% for every year you wait, all the way to 70. About 77% more than the early check. And there is a detail buried in this one that almost nobody knows. The size of your Social Security check is not what decides how it gets taxed. Your other income decides that. Keep that one in your pocket. It is the whole story in a single line. Paycheck 3, the pension. Fewer of you have one now, but if you do, it usually starts on its own schedule. You rarely get a say. And every dollar counts as taxable income, which means a pension quietly raises your income floor before you make a single decision of your own. Now watch what careful people do. They start Social Security early because guaranteed money feels safe. They leave the 401k alone because somewhere along the way somebody said never touch it. And the pension starts whenever it starts. Every piece of that sounds responsible. And that exact order is what sets off 3 tax traps, one after another. Stay with me, because once you see the traps, the right order becomes obvious. Trap 1 is the big one, the Social Security tax torpedo. The IRS runs a number on you called combined income. That is your regular income plus any tax-free interest plus half of your Social Security. As that number climbs past certain lines, more and more of your Social Security gets pulled onto your tax return. Married filing together cross $32,000 and up to half your benefit can be taxed. Cross $44,000 and up to 85% of it can be. Filing alone, those lines sit at $25,000 then and $34,000. Now hold on to this part. Those lines were written in 1983. They have never once been raised for inflation. Everything else in your life went up. Groceries went up, rent went up. Those 2 lines never moved an inch. Watch what that does in real life. You are married, combined income sitting at $43,000, just under the second line. You pull $2,000 from the 401k for a trip. That $2,000 tips you over, and about $1,700 of your Social Security becomes taxable right along with it. You withdrew $2,000. Your taxable income went up $3,700. In the 22% bracket, that little trip cost you more than $800 in tax. That is an effective rate above 40% on your own money. And you would not be alone. More than half of retirees now pay tax on part of their Social Security, pull the wrong dollar from the wrong place, and it does not get taxed once, it gets taxed twice. Trap 2 hides for 2 full years before it hits. Medicare IRMAA. If your income runs too high in a given year, your Medicare premiums go up. The twist is the timing. IRMAA is based on your tax return from 2 years back. Your 2026 premium is decided by what you earned in 2024. For 2026, the first line sits at $109,000 for singles and $218,000 for couples. Go $1 over and a surcharge lands on top of your standard premium. For a couple, that can run past $2,000 in a single year. And by the time the letter shows up, the decision that caused it is 2 years behind you. You never even get the chance to connect the two. I know that is a lot of lines and look-backs stacking up. Take a breath. You do not need to memorize any of this. You only need to know these traps exist so you can walk around them. That is the entire job. Trap 3 is quieter, and most of you will never trip it. The net investment income tax. Pull enough in one single year to cross $200,000 filing alone or $250,000 filing together, and an extra 3.8% stacks on top of everything else. So why mention it at all? Because it proves the pattern. One oversized withdrawal in one single year can wake up taxes you never even knew were sitting there. That is exactly why smart retirees spread their moves out. Which brings us back to the question this whole video opened with. How does $20,000 turn into $37,000? It is not that your withdrawal gets taxed at some monster rate. It is that the withdrawal drags your Social Security onto the return with it. Picture a married couple collecting $40,000 a year in benefits, sitting near that $44,000 line. They pull $20,000 from an IRA. That one withdrawal can drag about $17,000 of their Social Security into taxable income alongside it. 20 plus 17, there is your $37,000 income on paper. Money you are taxed on that never once passed through your hands. So let me ask you something directly. Do you know your combined income right now? The real number, not a rough guess. Because that one number is the difference between keeping your money and handing some of it over by mistake. And a quick note before we go any further. This is education, not tax or financial advice. Run your own numbers or sit down with a qualified planner before you move anything. Now, the good news, and it runs opposite to instinct. Flip the order. Spend your most flexible money first. Delay Social Security if you reasonably can, and treat the pension, if you have one, as the floor you plan everything else around. In the years right after you retire, before Social Security ever starts, you live on cash, your regular brokerage account, and planned 401k withdrawals. Why does that work? Because a dollar you pull from the 401k before you claim Social Security cannot set off the torpedo. It cannot. Social Security is not on your return yet. There is nothing for the withdrawal to drag in. And those same years hold a second gift. Your income is the lowest it may ever be again. That makes it the cheapest window you will ever get to move money out of a traditional IRA and into a Roth, paying tax now at 12 or 22%. Once it is inside the Roth, it grows tax-free, and when you spend it later, it stays invisible to every trap in this video. It never counts toward your combined income. It never counts toward IRMAA. It cannot be touched. Think of retirement as two phases. Phase 1 runs from the day you stop working until 70. Low income, maximum control. That is your conversion window. Phase 2 is 70 and beyond. Social Security at its largest, a much smaller traditional IRA, and a tax-free Roth bucket topping up your spending. And because you shrank that traditional IRA during Phase 1, the forced withdrawals at 73 stay small and gentle instead of shoving you into the traps all over again in your late 70s. Let me make this concrete. Ray retires at 63. His pension does not start until 66. So for 3 years, Ray lives on his brokerage account and converts just enough IRA money each year to fill up the 12% bracket. At 66, his $38,000 pension switches on, so he dials the conversions down to stay clear of the IRMAA line. At 70, he claims Social Security at its maximum. By then, his traditional IRA is small, his required withdrawals are light, and his Roth covers the extras without adding a dollar of taxable income. Ray never earned more than his neighbor. He simply turned his paychecks on in a smarter order. One more piece of good news for right now. Starting with the 2025 tax year and running through 2028, there is a new senior deduction. $6,000 per person, $12,000 for a married couple once you are 65 or older. It does not switch these traps off, but it hands you extra breathing room while you put those quiet years to work.
And I have to be straight with you, because your life is not a spreadsheet. If your health is poor, if the savings are thin, if you need the check today, or if you are widowed and the benefit math changes, starting Social Security early can be exactly right for you. There is nothing wrong with that. The rule was never wait no matter what. The rule is know what each order costs before you pick one, and never let the tax side decide what your retirement looks like. Decide the retirement you want first, then arrange the taxes around it.
So here is your simple path. Question 1. Do you have a pension? If yes, it fills your income floor all on its own, so guard those IRMAA lines closely. Question 2. Can you cover your bills without Social Security for a few years? If yes, delaying just became your most powerful move. Question 3. Are you sitting near an IRMAA line or the edge of a tax bracket? If yes, no big withdrawals in any single year. Spread them out. That is the whole map. Bottom line. The right order was never about squeezing the most out of one account. It is about paying the least tax across your entire retirement, so more of what you earn stays yours. For a lot of you, that means flexible money first, Roth conversions while the traps are still asleep, and Social Security waiting until 70. Your one move this week, find your real combined income number. Not a guess, the actual figure. Then tell me in the comments which order you were planning to use, Social Security first or the 401k. And I will tell you if the torpedo is waiting inside yours. Next time, we take on the number itself, how much you actually need in these accounts before any of this even matters, and why the figure everyone repeats online is almost never your figure. Subscribe so it finds you when it lands. This channel is one retirement decision at a time. Nothing sold, nothing rushed. You built this. The last job is keeping it. Take care of yourself. I'll see you in the next one.